The COVID-19 pandemic has affected all small businesses in the U.S. Virgin Islands, but there is help to move your business forward. The Virgin Islands Small Business Development Center is available to assist entrepreneurs and small businesses. The VISBDC is the territory's #1 resource for small businesses and is sustained by the University of the Virgin Islands and the U.S. Small Business Administration. The VISBDC is nationally accredited and provides one-on-one advising, business education training, and technical assistance at no cost. Attend workshops by experts from both the public and private sectors. From idea generation to exit strategies, the staff at the VISBDC are ready to assist you. So don't wait. Call, email, or visit them on the web at www.visbdc.org and Facebook, or simply download their mobile app on the Apple or Google Play Store. Just search VISBDC. Discover how they can help your business grow and succeed.
Welcome to the VISBDC Business Development Series. Today's presentation is entitled We All Keep Score, the Fundamentals of Personal Credit. I'll start by introducing our business advisor and presenter for today. Raymond V. Henry is a professional ASBDC Virgin Islands business counselor on a mission to enlighten emerging and existing small business owners about the day-to-day operations of running their own business. He offers high quality professional business counseling and training in operations, accounting, finance, export, and trade to small businesses. A graduate of the University of the Virgin Islands and with 25 years experience as a commercial banker gives him the advantage of getting the job done quicker. In 2016, he was selected as a state star for the ASBDC Virgin Islands. He is a founding member of the SCORE Virgin Islands. Just a friendly reminder to put your questions in the chat and they will be addressed by Mr. Henry either in the chat or later during the question and answer segment. A copy of the presentation is available upon email request to info@visbdc.org. We encourage you to take a few minutes after this training to fill out the survey that lets us know how we are doing. Business Advisor Henry, the floor is yours.
Good morning and welcome. Welcome all to We All Keep Score, Fundamentals of Personal Credit. One of the questions we should ask, what is credit? And what is personal credit? Credit is the ability to use something now and pay for it later. If you do that on a personal level, that's personal credit. The most important C in credit is character. And today you've joined us for the fundamentals of personal credit. Personal credit tells us that the C in credit is for character. We all keep score whether we want to accept it or not. You've had my introduction. And here is our agenda for today. What is my score and what does it say about me? How is my score calculated? Who generates my score? My score and the law. Free copy of my score. How can my score be improved or cleaned? And then we'll have a conclusion. Part of our mission at the VISBDC is to assist small businesses. One important aspect of small businesses are the individual owners and the individual owners' personal credit score. As an individual, if you were to go into business, your personal credit score will be very important in your ability to secure small business loans. Many lenders will use your personal credit score as a go, no-go metric for your business loan approval. That's why it's important, excuse me, to understand what your personal credit score is and how it is calculated. Even though your credit score offers an incomplete picture of what your worthiness is if you're going into business, many lenders use it as a short form of making decisions. Personal credit, what does it say about me? It tells lenders, vendors, creditors, and friends something about you. Why is credit important? The credit record is used by many to evaluate your credit worthiness and to make decisions. It's important to make decisions to sell to you, to lend to you, to lease equipment, to increase your line of credit, to offer favorable terms, financing rates, and to consider you as a partner if another individual wanted to do business with you. In this modern day and age, your personal credit score is even used for employment. Surprisingly, an employer would want to know what your credit score says about you before they employ you. The score allows a view of the past and allows the users of your credit score the ability to guess what your credit behavior will be like in the future. I will restate it and say the credit score is a short form that lenders, vendors, creditors, and friends use to make a decision without knowing you in person. Your credit report is used to calculate your credit score, but it does not include race, age, religion, national origin, sex, marital status, salary, location. These are not included. The personal credit score is a number, and we all have numbers. We all keep score, whether we know it or not. And there are three major personal credit reporting companies. One company ranges, let's say company A ranges 300 to 850, company B 330 to 830, company C 150 to 939. These are the three major companies. I will give them their names in a minute. Your personal credit is based on a mathematical formula. It's called an algorithm. And it's quite complex because it takes information from the three credit reporting agencies and it boils down into 5 major areas. Payment history accounts for 35% of that algorithm of mathematics. I wouldn't pretend to know how it works. I've looked at the formula and it takes mathematical scientists to come up with it. It was done in 1989. But all the major credit reporting agencies have used it. What you need to understand that payment history accounts for 35% of your final score. Another major section of the calculation is amount owed, and that's 30%. Another way of saying amount owed is what is called utilization. Utilization is if you had a credit card with a limit of $1,000, on average, the credit companies would expect you to only use 30%, although they give you a limit of 1,000. If your utilization or the amount owed on that particular credit is more than 30%, the algorithm, the mathematics that creates your credit score is affected. So you want to pay attention to these two first areas of your credit score calculation. Payment history is 35%, amount owed is 30%. So that's 65% of your score, whatever it is, with company A, company B, or company C, which I will mention in a minute. You want to pay close attention to the amount of utilization and your payment history. Length of credit history in that mathematical calculation accounts for 15% of your credit score. Length of history is straightforward. It depends on how long you had the credit or your credit history. And that is one reason when people are trying to maintain their credit score, you want to keep your oldest existing credit. Types of credit is another area of that algorithm or matrix that is used by the credit reporting agencies to calculate your credit score. It's a system of telling your lenders that you can handle mortgages, you can handle car loans, you can handle student loans, different types of credit. So in your credit profile, depending on what kind of credits you've got in there, overall, it accounts for 10%. New credit is given a 10% value in the algorithm that calculates your credit score. By new credit, it reflects over a period of time how often you have created or applied for new credit and got it. Major personal credit bureaus are, and earlier I called them A, B, and C, but here are their names. And they are responsible for calculating your personal credit score. Experian, and Experian has a range from 300 to 850. Equifax, 350 to 850. TransUnion has a score that goes from 150 to 934. Given those ranges, anything below 579 is considered bad. 580 to 619 is considered poor. 620 to 679, a score you would think is okay or fair. If your score is 680 to 719, it's good. 720 to 799 is very good. And above 800 is excellent. But let me take a little time to tell you what a score of bad or below 779, how it's interpreted by your lenders. There is some finance, if you have a score below 579, it says there is some financing available for borrowers with this type of credit score, but it is considered high risk and will likely come with higher interest rates. It is very unlikely this borrower would be able to qualify for a traditional bank loan or a loan from SBA. Let's skip poor and go to the interpretation of a score of 620 to 679, which we say is okay or fair. The interpretation is, this is considered a moderate risk credit score. A small business loan is very possible, but would likely not come with lower interest rates. If your personal credit score falls within this range, expect to pay moderate to high interest rates. A 650 credit score is the bottom threshold for SBA financing. 650 is the bottom threshold for SBA typical financing. Let's skip good and go to very good, where you have a score between 720 and 799. And here's the interpretation. If your credit score falls within this range, you are considered a low-risk borrower and will be able to find a loan just about anywhere. A borrower with this credit score should expect to be offered excellent interest rates along with possible perks. So our goal of a personal credit is to have it above 720. Let's take another example with actual dollar numbers of the interpretation of a FIA personal credit score. And you will recall what the FIA is. It's between 620 and 679. A personal credit score often leads to more favorable loan terms and lower interest rates. In this example, a FIA personal credit score can cost you. Here's the example. A 30-year-old man living in New York, based on credit.com tool, lifetime cost of debt calculator. The lifetime cost of debt numbers are below, depending on your personal credit score and average assumptions. A FIA credit score, his cost would be 606,086. A good credit score is the same man with 30-year-old man, his cost would be 523,0339. And a excellent credit score, his cost would be 481,390. It's amazing how the bump from fair to good reduces the cost of credit over a lifetime by 83,047. An excellent credit score reduces your cost, in this example, by 124,696. The lifetime cost of poor credit score, 759,490, and bad credit, it would cost you 915 to get that same level of credit. We spoke earlier about Equifax, Experian, and TransUnion. But I'm sure you've heard of FICO. FICO is a registered trademark of the Fair Isaac Corporation in the United States. They're the most popular and most commonly used credit reporting agency. And because of that, everybody knows them as FICO. What's your FICO score? It's the same 3-digit number calculated from information on your credit report. It summarizes the data in your credit report into a single number that lenders can use to assess your credit risk. Now, personal credit and your score is a shorthand used by lenders, like I said earlier, to assess your credit risk. Two key factors affecting your personal FICO score is the proportion of loan balances to loan amounts is too high. If that proportion of the balance is too high, it weighs down your mortgage and installment loan balances against original loan amounts. They use that particular information to affect your FICO score. The other factor that is important to the FICO score is too few accounts currently paid as agreed. The FICO score considers the number of accounts where you are paying your bills as agreed. Those are the two major factors, apart from the algorithm that is being used, that goes into your FICO score. Here's some more information about FICO. The FICO mortgage score is between 300 and 850. The higher the score indicates lower credit risk. Each individual actually has 65 credit scores with the FICO scoring model, because each three national credit bureaus, Equifax, Experian, and TransUnion, they all have their own database, and all that information is forwarded or used by the FICO company to generate your FICO mortgage score. Many of the top Fortune 500 companies are FICO clients. That's why if you want to talk about your personal credit score, you need to know what FICO is all about. FICO clients include more than half of the top 100 banks in the world, more than 600 personal and commercial line insurers in North America and Europe, including the top 10 US personal line insurers, 400 plus retailers and general merchandisers, including 1/3 of the top 100 US retailers, 95 of the 100 largest financial institutions in the US, and all 100 largest US credit card issuers and more are clients of the FICO company. There are several types of FICO scores depending on what the lenders want to know about you. There's the classic or generic, there's a bank card. You could tell there's different scores based on what different institutions are using the FICO model. Personal finance, mortgages, installment loans, auto loans, and there's the next gen score. There are other special factors which can weigh on your FICO score. Any money owed because of a court judgment, tax lien, carries an additional negative penalty, especially when recent. Having one or more newly opened consumer finance credit accounts also would maybe considered negative because of the algorithm and the 5 major breakdowns of that algorithm. New credit is considered a detriment or to affect your score in a negative way. The other aspect of your personal score or your credit score is the law. The federal government thinks it important that individual consumers get some kind of protection, given the history of credit in the capitalist US system. There is the Equal Credit Opportunity Act that is to help you get some kind of protection. It entitles you to be provided with the reasons for a decline in a loan request, as well as a copy of the report that was used as the basis for the turn down. So if you got turned down by a local bank, they will not only tell you they've denied you credit, but they're going to give you a reason why they denied your credit. What I have found in the examples I've seen is they give you a very generic answer because they have to comply with the act, and said that the decision was based on information taken or used from one of the 3 major credit reporting agencies. They'll say Experian, TransUnion, or Equifax. Usually they comply with the act, but it doesn't really give you a good reason why you turned down. But the act requires them to give you a reason for your decline. The Fair Credit Reporting Act, by law, if the reporting agencies cannot verify the information in their report, it must be deleted. So that's another act that can be used to get clarification of information in your credit report. Therefore, you challenge all the things in writing, because in your, let me share some statistics with you at this point. You're protected by the Equal Credit Opportunity Act, and you're protected by the Fair Credit Reporting Act. But here are the statistics. 79% of credit reports have errors. 61 million Americans have poor credit. 33 million Americans have no credit score. 24 million Americans have no credit file. And those are reasons enough to challenge under those two acts. In your credit report, you could challenge a wrong address or any typos. Items over 7 years that's still in your report must be omitted. Liens that were paid must indicate paid. Charge-offs should be challenged. Then it's your responsibility to protect your personal credit, to check again next month and challenge again in writing, and again next month. That's what the law allows you to do. So how do you get a copy of your credit report? The federal government considers your credit report essential to your financial life and has mandated or made it so you could apply for a free copy from each of the 3 major credit bureaus at least once every year. And you can get that information from www.annualcreditreport.com. You go to that website, and then you pick which credit agency you want to get a report from once a year. So you could end up getting 3 annual reports, and you can compare them. They're not going to be exact because each of the companies are private companies, and they emphasize different aspects of your personal credit. You can get a copy of your credit report from other sources, but they may not be free. You could also go to myfico.com or freecreditreport.com. How to manage and improve, clean your report or score? These are the easiest steps. You need to know your score. You need to keep your personal credit separate from your business credit. Don't apply for credit you don't need, and don't jump around. Here's the reason for that. There's something called soft credit pools and hard credit pools. If you needed a car loan, you probably don't want to go to each of the local banks here and apply and see which one will give you the better rate. Because each one would then have to report to the credit reporting agencies, and that would affect your credit score. Get current and stay current on every account. You can manage your personal credit score by paying your bills on time. Remember credit, payment history. Avoid using credit to the maximum limit. Remember, utilization is at 30% of the algorithm or mathematics that is used in calculating your score. If you are new to credit, restrict the number of sources of credit you take on. And be wary of people who claim they can drastically improve your score overnight. There are no quick fixes. And the reason there is no quick fix in your personal credit score is, please recall the algorithm that is being used. Your payment history, your utilization, the length of credit, the types of credit, and how many inquiries you have had credits you have recently. So doing one thing by itself may not automatically improve your score. It takes some time. That's why I'm saying you have to be wary of any quick fixes. As we come close to the conclusion of this presentation, a good credit score is your passport to competitive interest rates. If you have a good credit score, you probably will get preferential rates for mortgages, for cars, credit card offers, job offers, insurance premiums. And if you, as an individual, you decide to go into business, as we said earlier, your personal credit is a foundational aspect of your business loan. Your character as an individual who owns a business is important to a business loan request. A strong score is worth money because it saves you in excess cost. The excess cost is all that interest expense that you're going to have if your score is below par. And with this, we've come to the end of our presentation, and our contact information is now available. We will remain available to answer some of your questions and provide some additional information based on the questions that you have for us today.
So as we create the opportunity for questions to be placed in the chat, I would just like to give a friendly reminder that the VIS BDC has so much in store. As you can see on the screen, our website is www.visbdc.org. We encourage you to download the VIS BDC app on your mobile device from the appropriate app store. Like and follow us on Facebook, Instagram, Twitter, Google My Business, and subscribe to the VIS BDC YouTube channel. And just a few of our upcoming webinars as March approaches. On the first, we have SBA with Webinar Tuesday, Ascent for Women Entrepreneurs Program. So that's going to be March 1st at 11 a.m. On March 2nd at 11 a.m., we have Starting Your Business in the USVI. On the 2nd at 6 p.m., we have the webinar Using Science to Improve Your Bottom Line. On the 3rd at 10 a.m., we have the USVI EDA Economic Development Bank with the microcredit and intermediary relending loan programs. On the 3rd at 5:30 p.m., we have Small Business Conversations from the Front Line, Supply Chain Challenges and Opportunities During COVID. And on the 9th, we have at 7 p.m. SCORE, and they're presenting a webinar called Building a Paid Marketing Strategy. So I do see a question, Mr. Henry.
Okay.
Did you say that we should challenge charge-offs? If so, why?
Charge-offs should be challenged if there is a reason to challenge them, because they remain on your report for at least 7 years. So if you could challenge them and get them off, that would help your credit score in the long run. Because what happens with a charge-off, if you understand what charge-off is, if you had a car loan, and for whatever reason it got repossessed by the lender, and you owed 10,000 still on the car, but you were only able to sell it for 7,000. The lender has a shortfall of 3,000. They may decide to pass that difference to a collection agency or just charge it off their books. So you want to be sure whatever amount that they have as charge off is correct. You want to just be absolutely sure that it's correct, and that if it can be removed, since it was charged off, you could request that it be removed. Based on that question, I could add some more information. Here are some negatives items that you could consider because they'll be in your credit report, or they are considered negatives in your credit report. High balances is negative. Late payments is a negative in your report. A charge-off is a negative. Repossessions are a negative in your report. Bankruptcy is a negative in your report. If you had a judgment, that's a negative in your report. Liens is a negative. Foreclosures, and if there are duplicates in your report, you want to challenge them as well. So to balance it off, here are some positive items for your credit report. Low balances, on-time payments, aged accounts, which goes back to the algorithm that says length of credit, accurate information in your report. And another positive is a mix of credit.
Okay, we have a question from the Facebook Live. Mr. Henry's direct extension, you can call him at 693-1118. That's 693-1118. Mr. Henry, I don't see any more questions at this time. Oh, here's one. Should you close accounts that you have had for a long time if they are in good standing?
The short answer is absolutely not. Because the way your credit score is calculated, the length of credit is an important part of that algorithm. So even if you have a credit card that you're not using, but it has a $5,000 or $10,000 limit, you shouldn't close it, because it's in your report and it will have shown that you were able to handle credit from 10 years ago at the limit of 10,000, even if you're not using it right now. And that's the reason why you don't want to close it, because it adds to your length of credit.
Okay, so that seems to be it for our questions. So I'm going to take this time to close and thank everyone for your time on behalf of the VISBDC network. Wishing you a productive rest of the day. Thank you.
Thank you.